Hi, I'm Ross from Coombe Smith Chartered Accountants. So the seminar is, do you need to sell a rental and reduce risk and move ahead? The first thing we always have is a disclaimer. So this is general advice to give you general advice about property situations. It's not specific advice for your circumstances. So if you need to get advice, you make sure you see an expert. So as I mentioned, I'm Ross from Coombe Smith Chartered Accountants. We're a firm who specialises in property accounting and we're based in Hamilton, New Zealand. We've also got Joe Harris from Lodge Real Estate talking later on. So I'm going to start off with the property cycle. So basically over time, property generally goes flat for about 5 or 7 years. It then booms, and the last boom went from about 2003 up until 2007. And then it's gone flat for the next 7 years until about 2014, 2015. And then we've had a huge boom at the end where the property market has jumped up over the last 18 months. The hard thing at the moment is to know how long is this boom going to go for, and none of us have a crystal ball. There is no perfect answer. We don't know how long exactly it'll go up for. But based on history, and this is all assumptions based on history, we're then going to go flat for a period of time. This last flat period was for 7 years, so therefore you'd sort of expect this to go for 7 years. And then at some point we'd expect the property market to boom again. So this brings interesting information. If you're looking at selling, you really want to sell around this period here. Otherwise, you're sort of going to wait for a 7-year flat period, perhaps until you can get a really good sale value again. So it's really important if you think that you've got a property that you need to sell, thinking about when you want to sell that, or do you want to keep it through longer term. So the key ingredients of what we talked about is the boom will end. Property booms in the past have always finished. A flat period will follow, and then there'll be a boom again. So that's what history can tell us. Will the future be the same? Unfortunately, we don't have a crystal ball. We don't have that perfect answer, and neither does anyone else. So property prices could fall. They might not go up forever. The flat periods seem to be getting longer and longer. So the last flat period was about 7 years, and the one before that was quite a lot less, probably about 5 years. Just a general thing before we really get into the key information. The Auckland Market at the moment, there's a huge housing shortage. Huge immigration and huge growth. And yeah, I'm probably not sure that this will follow the same pattern. So basically our advice for the rest of this presentation is non-Auckland related. If you've got an Auckland property, I would be personally very, very hesitant about selling that property, and I would try and keep it no matter what, because I think that market is just so strong long term. So yeah, everything else we talk about later is really about non-Auckland properties. So what we're looking at is, what is your current position at the moment? Can you cull off a property or two, and will that put you in an ideal position? So it's knowing a little bit what your current position is at the moment, what you want to be like at the end, what is your goals and aims, and what we need to do to actually help you get there. And the whole idea with culling or selling off properties is to improve that position. So I look at it that you might take 1 step back, but to go 2 steps forward later. So the sort of items that we look at, we look for properties that are cash flow deficit. So if your rent is not covering all the expenses, it's cash flow deficit or cash flow negative, and that's not ideal for you. If you've got large repairs coming up, so especially if it's the roof or the foundations, they're major problem areas, and I try and keep away from those 2 areas. Do you have a lemon? And we'll talk a bit more about what a lemon is later on. And is there some twists? So twists are a positive thing. You might be able to subdivide the property and put a dwelling on the back. So we look for positive things as well as negative things. And tenant hassles as well. I personally don't manage any properties, and I personally can't be bothered looking after tenants. And to me, if a property is giving you a whole lot of hassles with the tenants, then that might be a reason you might look to get rid of it. Key idea here is everyone is different. There is no perfect answer. What's perfect for me might not be perfect for the next person, and probably not perfect for the next person person either. So everyone's got different age, we've got different risk levels, and we've got different goals at the end of that as well. Cool. So we're going to move on to some case studies. So if you're watching this in video, I would suggest you quickly read over the case study information that we've provided and then run through this with me once you've got an idea of that information. So our first case study, we're looking at Bob and Jane. They've got 3 rental properties. The first one is based in Rototuna, which is Hamilton. They bought it for $550,000 a few years ago. They've still got a mortgage of $550,000, but it's jumped up in value to about $800,000. So we've got quite large equity sitting in there, $250,000. The rent's $450 a week. The gross yield based on the value now is really low at 2.81%, and we're losing about $6,700 of cash a year. The second property is virtually exactly the same, and so we're losing $6,700 on those properties. Both those properties have good tenants, they're newish, they're brick and tile, so very low maintenance. They've got no spare land, there's no sort of twist that we can do on it or anything special. Then the last property is a Wanganui property. It cost $125,000, it's now worth $130,000, and they've got a full mortgage on it, so there's only $5,000 of equity. It's an old property, it needs some work, there's tenant hassles. The big plus is it could be subdivided. The rent is $250 per week, which if we look at a gross yield based on 50 weeks, it's actually 9.62%. And so 9.262%, and it's losing $3,000 per year. So what that shows is even though the gross yield is fantastic, 9% is really good, because the rates are so high in proportion to the rent, the insurance is so high in proportion to the rent, and also high repairs and more vacancies, we end up with a cash loss soon. So the big problem with this overall, our cash loss overall is $16,000 over the 3 rentals, which is a lot of money for them to put in year after year after year. So what would you do with this situation? The first thing I look at for any place is the statistics. So when people ask me, should I buy a rental in Wanganui? I Google Wanganui population, and it pops up that there's 42,000 people normally live in Wanganui. This is a decrease of 486 people, or 1% drop from the year before. And if you actually look further, you'd find the census information for the period before is exactly the same, and there was a population decline. So to me, if you've got less people, they need less houses, that means you have less tenants, or your values go down long term as there's less demand. So that's what I would call a lemon. There's low population, there's low growth, cash flow is negative because it's losing you the $3,000 a year. There's repairs and there's tenant hassles. To me, you've got a lot of negatives there. And the only thing you'd sort of look at is the subdividable. To me, the subdividable is probably a lot more hassle and cost than it's really worth. If you subdivide it and then you build another property on there, your costs are going to be really similar to Hamilton or Auckland, but your rent and value is obviously a whole lot less. So when we're looking at what possible approaches you could do if you're Bob and Jane, is I would look at selling Wanganui. And that doesn't mean that you have to sell it today. I would look at establishing a plan and gathering information. So first of all, finding out from maybe 2 agents, what's the best time to sell, what sort of value do they expect, and what sort of rent, so that you can check your rent is reasonable. And then working out a plan of when you're going to sell that. I would sell 1 Rototuna property now. That means that long term you'd be left with the second Rototuna property, so a good newish property in a good area, but you'd only have a $295,000 loan, and that would be cash flow positive. So rather than putting in over $16,000 a year at the moment, you'd end up at actually making a little bit of money, and all that extra cash, $15,000 or more, you could then put into debt repayments, and that's just a constant sort of winning cycle. The more you pay off the loan, then you end up with less interest, so then the next year you can put more and more in. So that's just a possible idea I would look at. That's quite conservative, but it puts you in a really strong cash flow position. But if property prices still go up, then you've still got one rental left, so you can still benefit well from that, but really improves your cash flow. Second case study. So this is Malcolm and Brenda. They're a retired couple. They've got no other investments. They're conservative. The investment advisor has told them that they could earn 5% plus in other investments, and they just care about cash flow. They've got lots of capital, and they really just want income to live on. So they're a little bit different to a lot of people. They've got 3 rentals. They're all good rentals. They're all low maintenance, newish. They've all got no mortgages. So basically all the rent, the rates and insurance and a few other costs is coming through to them in a cash profit. So they're making about $30,000 a year cash profit. All their property values have jumped up in value. So where something like Restructuring was giving them a 5 or 6% gross yield on a new property, because of the increase in value, it's now only about 2.81% or 3%. And their cash return based on that value invested, they're only getting just over 1% return before tax. So if you sort of compare that with something obvious like bank investments, where you can get 3.5% invested in the bank, that 1.37 is very, very low. So what we're looking at is, these are all great properties, great areas, low repairs, great tenants, no hassles. They're all new on sections, so there's nothing you can really do with them. There's no subdivisions, you can't add minor dwellings. So what we're looking at is, what would you do with this? And I suppose the key thing for me is the picture probably gives it away a bit, and you've got that old saying of all your eggs are in one basket. So I'd look at reducing that risk and spreading the eggs into different baskets. So from the comments that they said, they want cash flow. They've got enough equity, but they want cash to live on. So Restructuring is only giving a 1.25% return on the value of that property. The investment advisor thinks they'll get 5%. I'm not an investment advisor. I'm not going to say whether that's correct or not, but they've got another option where they're happy that they can get 5% or more. If they change that around, sold the 800,000 Restructuring property, they would both get 40,000 income compared with the 10,000 they're getting at the moment. So a possible approach I would look at is I would reduce the property risk. They've got all their assets in 3 investment properties, and as well as owning their own personal home. So by selling an investment property, they're reducing their risk and their reliance on property. It still leaves them 2 properties, so if property keeps going really well, they're still going to benefit well from that. They gain 30,000 cash flow per year, and in 1 year's time, if the market keeps booming, I would actually look at selling the second worst performer of those properties, which is probably the Cambridge property, and looking at doing the same thing, converting from property to some other form of investment to improve your cash flow. Our third case study is James and Wendy. They're a young couple in their 30s. They still have a personal debts. They still owe about 300,000 of debt, and that costs them about 300 per week in repayments. Their big aim is to be debt-free on their personal house, and then they're looking at long-term capital gain and passive income. They've got no time and they've got no subdivision or build experience. So their first rental, Hamilton 1, it's a large section where they could perhaps do a duplex or minor dwelling. The rent's $350. They purchased it for $250, so their mortgage is only $250,000. So they've now got large equity in there. Their gross yield, 350 times 50 weeks, and then divided by the 550 value, is only just over 3%, and it's losing about $1,800 a year. It's an older property. It needs some repairs. They've got reasonable tenants. If they put a minor dwelling on it, it would be 4,000 positive cash flow. Hawke's Bay property, it cost them $160. The loan is still $160, and now it's worth $260. The rent is $320, so the gross yield is a bit better, and it's actually cash flow positive. The last property is a villa in Hamilton. They bought it for $350,000, and it's now jumped up in value to $650. It's got roof and foundation problems, and it's about $40,000 to fix over the next 5 years. but it's subdividable and subdividable into 3. And at the moment it's costing them about $6,000. So if this was you, what would you look at doing? So some options. One option is we could look at restructuring. We might be able to sell the rentals or restructure them into a new entity like an LTC so that we can get all the debt onto the rental properties, so all the interest on that would then be tax deductible. So that's one option we could look at. In this case, I always suggest that they finish projects. A lot of people say, oh, we could do a minor dwelling. Then the market changes, the lending rules change, and they find that they can't actually borrow to do that. So I'm always a big fan of actually doing those projects now and finishing them off, rather than having 10 unfinished projects and then the market turning and you still having 10 negative properties, rather than having good solid investments that are paying for themselves. So a possible approach I would look at doing drawings and initial work for the villa so that you can make it as attractive as possible, and then basically trying to sell it at the moment on a hot value and selling it with the subdividable aspect. So if you've got plans all drawn up, people can see this is how you can subdivide it, then that adds value and you're likely to get a very good price. I would then take the equity out of that property and use that to pay off my personal house, so then you're debt free on your personal house. And that was one of the aims of the young couple, was to become debt free, so it's meeting that aim. I'd then do a duplex or a minor dwelling on the rental one. In Hamilton, the new rules have come through that generally you can do duplexes, which is 2 houses joined together. So that's going to give you a really good rental return, plus give you most likely a capital gain if you build smartly. And so what we're doing in the end of this, sorry, I've jumped ahead, is you'd end up then with debt-free personal house. They would still have their rental property in Hawke's Bay, which is just cash flow positive, and we would have also turned the first rental in from a cash loss into about $4,000 a year cash flow positive. So again, it puts James and Wendy into a really good position. They've got good cash flow, no personal debt, and then they can actually start paying off those mortgages further as well. So hopefully those examples or case studies have given you a good idea what sort of things you can look at, and what situation I would look at selling a property and what situation I'd look at keeping them or doing things for them. So what sort of things to look for. The main question that we're after is, does that property help you reach your goals? If it's not, then why do you still have it? And if it is, then it makes sense to keep it. This is actually a slide that I've stolen off Lodge Real Estate when we've presented with them in the past. And to me, as an investor, what we're really looking for is financial freedom. So you're wanting to get income from something not related to your work. So debt-free rental properties, for example, can give you really good passive income that you don't have to work for. You don't have to get out of bed in the morning and go to work. And then that just gives you a chance to travel or do other things that you want to, which is what we're all after. Just one last slide that I'll touch on before I finish and pass over to Joe. And there's always something that we need to be careful with property investment, and that's interest rates. So interest rates rising is our biggest risk. And at the moment you can borrow very close to 4% or even below 4% in some specials. But I often look at 6 or even 7.5% just to give a comparison. Long-term average interest rates are 7.5%, so it's just worth keeping an eye on that and what would happen if your interest rates go up. So that's all I've got for the moment, so thank you very much.
Hi, I'm Jo Harris from Lodge Real Estate. Just wanted to give you an update on the current market conditions to the end of July, which is the latest information that we have at the moment, with the results for August coming out in a week. We had 363 houses sold in July 2016 with the median sale price of $510,000. That's the first time that we have passed the national median, which at the same month was $505,000. There's a lot of properties coming on the market at the moment. We have on average about 600 houses currently on the market in Hamilton. 4 weeks ago we only had on average 400. That's providing the buyers more variety to look at, which means that we're not getting 10 bidders at auction, we might get 2. We're still getting really good results, and where they're not selling at auction, they're selling within a day or a week of the auction. So we're still getting some great results. Here's some more information on the number of sales in the different suburbs in Hamilton, and you'll see here the increase from 2012 up here to July 2016, the massive increase in values of homes. As real estate professionals, we have access to a lot of interesting information on houses. This is the median price movement from 1992 right up to today. If you want information like this, please email me on joh@lodge.co.nz and I can add you to my database and get you that information on a regular basis. So when is the best time to sell your home? Contrary to popular belief, there is no magical time to market your home. Really, it's the time that suits you. Your home needs to be ready to sell. There's a few marketing options if you do decide to sell your home. Depends on the type of house that you have and the type of market at the time. Every house is different, and for every house there's a different marketing option. A couple of the marketing options that we do have is running an auction program. If all going well, it sells on auction day. We have a cash sale for you within 3.5 weeks of putting it on the market. The other popular option is putting it on by a price. With this, you can get some cash sales for those buyers that have the ability to do that. Others, there'll be conditions like finance or sale of a house or limb, builder, etc. It's really important that when you do decide to put your house on the market, that you choose a real estate professional that you're comfortable with and really listen to what they've got to say. If you market your home at the wrong value, that can have a real impact on the on the price that you get for your house at the end of the day. It could end up selling below the market value. I'm really passionate about when I'm marketing a home that I talk to my vendors about removing any roadblocks that they have in regard to their property. Okay, I'll give you some examples of that. So one of the hot topics at the moment is methamphetamine. If you think for any reason at all that you should be providing a methamphetamine test to your purchasers, please do it. In fact, most buyers are actually doing that test before purchasing at the moment, so it's a really good idea to get one to provide to the buyers. A LIM, which is a Land Information Memorandum, is also, particularly for auction, a really good document to provide to your prospective purchasers. If your home, for any reason, is a home that, say, has a stigma, perhaps for leaky buildings. I've just had one that was an insul-clad home, and my advice to my vendor was that we actually get a moisture test and have that available for the buyers. That removes any roadblocks, really, any cause for excuses to buy your house. I always go to the council, make sure that there's an available Code of Compliance certificate that's available for any house built after 1993. And another option to consider is that you stage your home, particularly if it's vacant, allowing people to visualise how a property will look with furniture in it is really good to help market your home. So just a few do-up tips. A wise man recently told me that for every dollar you spend on the outside, you'll probably get $10 back. And for every $10 that you spend on the inside, you'll probably get your money back. Therefore, where is the best place to invest your hard-earned money when selling your house? To me, it would be on the outside. So, here's a few tips, 5 exactly, for outside of the home. Please, presentation is the most important thing. To get that buyer to your home, past the gate, into the front door, presentation of the outside of your home is just imminent. A soft wash, a few $100s, or do it yourself. Do the house, the paths, the fences. Tidy up the gardens. Make it look beautiful. Plant a few little flowers in the garden. When people are looking for your property, when they're driving along the street, what's the first thing they look for? The letterbox with your number on it. Does that look good? Gutters and roofs. Are they clean? Are they cleared out? Is the roof in good repair? Is there some loose nails? That's probably one of the most common things that we have when buyers do building inspection, is there's loose nails. So get up there and have a look, or get a building professional to do that, a roofing professional, sorry. Take away those excuses from the purchasers. If there's any little patches that need paint, touch it up. Okay, 5 inside tips. Declutter. Please, make your rooms look spacious and light. Make it look really welcoming. Whenever you've got buyers coming to view your home or for open homes, make sure that you've got all the lights on, all the blinds open, all the curtains open, tidy, beds are made. Make it look really special, that you're very proud of it. Do a deep clean. Clean those areas that you wouldn't normally clean. The door jambs, up high, all the kitchen area. Make sure it's just sparkling clean. Clean the windows, inside and out, please. Mirrors, they make a room double in size. I recently had a vendor who put a to-the-ceiling mirror in their bathroom. What a difference that made. It was amazing. Curtains. Now, if they've got a little bit of mould on them and you think it will come off in the wash, please do that. Otherwise, for a few $100s from Bunnings or Placemakers, go and have a look and see if you can get some nice fresh curtains. People look for those types of things. Door handles. That's another great way of lifting the kitchen area, perhaps, by just putting in some new door handles. It's an economical way to make things look fresher and more inviting. Okay, once you get past all of that, preparing your home for the market, it's really important that you advertise it in the best possible way. This is a package that I use for several of my vendors. There's variances of marketing that you can do. It all increases in price and it depends on your property. This one here, it's a good package. You get 3 double ads in the Waikato Times over 3 weeks. You get a large photo sign to go outside your home to show prospective purchasers walking by what they can't see from the street. You get professional photography. You get to feature on the Lodge website, the realestate.co website, and I have put into this package Trade Me, which is a great tool, particularly if you've got an investment property and you've got Auckland buyers. Colour flyers, they're all part of that package, and me to market your home and deal with all that hassle for you. There's only 3 weeks left of September, so if you are thinking of selling your investment property or your home, give me a call. got a chance to go in the draw to win your full commission back. Here's a little bit of information about myself. Thanks for listening. For more information or to discuss your needs, please give me a call. I'm Jo Harris on 0275 513 552. Keep smiling.